answers, it would give me an idea about what kind of audience I'm speaking with. I just open the chat. Okay. So mostly what we have is either 0, 1 or 2. Okay. 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 Perfect. Good. Okay. So you are able to hear me, right?
Yes.
Loudly? Okay,
Yes.
perfect. Okay, so what I will do is, although the topic says is decoding option complexities, right? If you guys have little bit of experience or has heard about it, right? It may look like a complex topic. Okay, so is not going to decode complexity. Topic is little difficult, and I will try to make it as easy as possible. But believe me, there is like 30, 40, 50 hours you can spend easily in options, and you still feel a little bit lost. What I would do is I would spend a good amount of time on some of the basic concepts, which would be the rock solid foundation. And on that concept we will build upon further, meaning you can go and read through there are various good resources available, but we would start with the rock solid foundation. And before we start, right, our customary disclaimer, essentially, the investment carries significant risk, and particularly options has a lot of risk, right? And is a raw power, and if you don't know how to utilize it, it can cut both way, right? It has a very good benefit, but it generally cuts the other way around if you are new and inexperienced. So whatever I'm telling here is all for the educational purpose basis. I'm not a professional investment advisor, and I'm not here to sell anything. It's only a knowledge and the education which I would like to share. I have close to 2007 I started my option journey. I attended one such session, and from there I built upon the knowledge of my own, and also the superpower of execution. I learned a lot in last 14 years or so. So risk stays is a weapons of mass destruction. You can lose a lot of money if you don't do it right way. So don't take anything in this particular material and start trading. No, this is not there. You will have to spend a lot of time before you become comfortable. So that's the advice. You don't go after the seminar and start trading it because you understand a little bit of it. There is so much things out here. You have to have a paper trading experience. You have to have give sufficient time before you do that. But it is a very interesting subject. Options is very interesting subject. The more you read, the more you learn about it, you will know it. So it's all about risk, right? And when I think of risk, right, I think for example brakes in the car, right? Now, you guys, do you think that the brakes in the car are to stop or reduce the speed, or is there to increase the speed? Generally, the conventional thinking is brake in the car is to reduce the speed. No, because the brakes are available, we are able to go in a faster speed. Same thing when we envisage the risk, and when we take care of that risk, meaning risk of losing money, and then if we are proper, we would go with the full speed. So risk is what we need to envisage. So having said all the disclaimers and all that thing, this is important. This is most important side. So in everything we have risk, right? So risk hai to ishq hai. So if you are doing stock trading or options trading, there is an inherent risk, and with that inherent risk, we need to fall in love. And the more, this is not the only exciting slide in this presentation. If you understand the options and the materials, there is a lot more things which is exciting. So I have given a dichotomy in the life. Everything is dichotomy. We have the risk disclaimer, but the second thing is if there is a risk, there is a love. And I'm truly passionate about and driven about the options. I have read it a lot, and my love for the options have increased, and here I am. But I will be sharing basic foundational thing and plus a little bit of advanced concept. I'll try to demystify a lot of things, but it is a guide or the roadmap, and you will have to explore it on your own. So let's start with the introduction to options. what I would be covering in this particular thing, the building blocks, right? What are the building blocks? A little bit of understanding of options, if you know already, good enough. Then there are two kinds of options, which is call options and put options. I'll discuss about what is call options, what is put options. Then I'll discuss the four strategies of spreads or vertical, which is called as bull call, beer call, bull put, beer put. So 4 plus 4, 8 strategies I'll try to touch upon. And I will also give a little bit of understanding on the Greeks. Greeks are nothing but the parameters. We are all engineers, right? We love mathematics and details around that. So there is little bit of correlations between various parameters of options. So that we will discuss in terms of delta, gamma, vega, and theta. One thing I will tell you, we all think we are very learned person and we have a very strong foundation in mathematics, and we have a sure shot success in the stock market. My experience in for having a success in stock market or futures or options trading, we need to keep our logic and knowledge on the side, right? It is all emotional driven journey of stock trading, right? So you need to be aware of your emotions and how you are taking actions and all that thing. If you know a lot of maths, it doesn't guarantee a success in stock trading. You need to go and understand the psychology of the trader, because the other people are trading. So you need to have the basic, but then you need to have this particular angle of psychology. Mass psychology is what I mean to say. Uh, when we go down into the details of call options, there are two types of options: long call, short call, long put, short put, and then the four types of the spreads. We'll go down into the details. We will discuss each and everything. A little bit of terminology thing is, when I say long call, meaning you are basically buying the call. When you are long, you are basically buying the call. So long call meaning you are buying the call. Long put meaning you are buying the put call. Put. When we are saying short call, meaning you have sold the call. Short put meaning you have sold the put. So that's the terminology. That's clear enough. You can put in your chat box if you understand that terminology. Long call meaning you are buying the call. Short meaning you are selling. You have a short position. Is clear? You can put your comment in the call box, chat box. Okay. Okay. Perfect. Then Warren Buffett, our legendary investor, he says he advises retail investor not to indulge into options, right? It says it is weapons of mass destruction. We have seen that kind of things again and again. I also agree with that. If you have little bit of knowledge, thoda sa seekh liya, and you are trying to go into the market, don't do that. Don't do that. You need to put down. It is not a get rich quick scheme. It takes time to understand. It takes time to come out with successful trades. They are weapons of mass destruction if you don't understand the risk and you leverage upfront. I'm saying that you have to identify what is your tolerance. Mostly for the first 5-6 months, I would suggest do it on paper. Try to understand what the market is trying to speak about you. They are very powerful, but they can cause destruction. Same thing, if you are a 16-year-old guy and you got a 300cc bike and you don't understand how it skates and all that thing, is weapons of mass destruction. But when you have gone through a structured learning, you understand the risk, and you understand the risk once you skid one time, two time. That is the real time when you learn. But hopefully, in the first instance of skidding, if your speed is less, you will survive and you will drive a lot. So same thing with options, right? You need to learn and then go down into the details. Very quickly, I'll skip the history of options. I'll just say that from 1600, the market for options was informally started. It became formal in the year of 1968 when the Chicago Board of Options (CBOE) was established, and from there the exponential trading in the options is happening. The volumes have increased. Before we go down into the option, maybe let me give a little bit of understanding of options before we speak that. So options instruments are there from a long time. It has matured. Initially, when it started, there was very low trading volumes, but now a lot of people are having interest It is very liquid instrument in US or across the geographies or also in India. I'm not going to delve deeper a lot into the option history. Is not important. What is important is this particular slide, basics of option. Basically, if you see what is option, let me give very basic example. Option is essentially a contract between buyer and seller for a future date. Okay, what is option? Option is basically वायदा बोलते हैं उसको हिंदी में. Option is essentially a contract between buyer and seller for an underlying at a future date. Let me just give one example. If you are if you are interested in a stock called Apple, for example, just take example of Apple. Say Apple is hypothetically trading at $100. Example. Okay, and you want to do a contract. You are a buyer and you are saying that okay, Apple price is going to go increase in next 1 month, 2 months, or 3 months timeline. So you have a bullish experience, but you don't want to buy the stock of Apple. You don't have that much money, but you still want to participate in the market. So essentially you enter into a contract with a seller who is ready to sell you the stock of Apple at $100. You are ready to buy the stock of Apple at $100, but not today, a month from now. So for example, today is 14th Feb, you want to buy for 14th March. Suppose there is a contract. So you are saying on the 14th March, I'm entering a contract today for 14th March. On 14th March, I will take delivery of Apple at $100 per share. So I have right to buy 100 shares of Apple at $100, and I am entering into the contract now. Clear? The seller has also entered a contract because there is a bi-party contract. Buyer has a right to buy, seller has obligation to sell. So it's a contract between two parties. So this is called option. Simple hai. Let me give couple of examples of options from the real life so that you understand that. So suppose you are interested in buying a property at Powai, right? We all went into IIT and we know that Powai is a market area. Prices are increasing every 6 months and all that thing. You are looking to buy a house. You like the house, but you don't have the money at the moment. And you have finalized the price with the seller. So suppose, 10 million. और 20 million, whatever, 2 करोड़ रुपए में सौदा नक्की किया. So what you will do is you will say to seller that I will buy this house in 6 months time at 2 crore rupees and I give you my assurance, and with that assurance I'm entering into a contract. Seller also agrees to that. In order for that agreement for a future date, you give a little bit premium, meaning you give a token amount of say 10 lakh rupiya, 20 lakh rupiya, you have given a token. Now that token is an assurance that I'm going to make good of if I want to buy at 2 crore rupees the house 6 months from now. तो ऐसा टाइप का होता है ऑप्शन टू परचेज बोलते हैं, ओटीपी बोलते हैं उसको हाउस में. So that is a valid scenario, right? I don't have a money now. I get a money 6 months from now, but I'm entering into a contract now. Okay, to buy. Same thing. All of us have taken insurance. Okay, so insurance is basically what? Insurance is if something happens to my life, I want somebody to pay me money equivalent to my life, whatever is worth, whatever is the insurance policy taken. That much amount the party will pay, the insurance company will pay. So what has happened in this case? I have bought a insurance, so I am a buyer and I'm betting on my own life, and somebody is betting on good life for me, which is nothing but the insurance company. So I have taken a put option that my life will go off and company will pay me some money, the full amount of money jitne ka insurance liya, 1 million, 2 million, whatever it is. And company is betting that this guy is healthy guy, nothing is going to happen to him for another 60, 70, 80 years, and I'll keep eating the premium because there is low probability of anything happening to this person who has taken the insurance. So insurance is the best example for put. In this case, whoever has taken the insurance, whoever has bought the policy, is the put buyer, and whoever has sold the policy, which is nothing but the insurance company, is the seller. Seller is also called as put writer. Okay, so options basically, again I'm telling you, a contract in future for an underlying at a specified price. There are two parties, one is buyer, other one is seller. Whoever is buyer is called as long side of it. Whoever is seller is called as short side of it. Okay, and whoever is buying, he is buying some kind of rights or privileges, so hence he has to pay the premium. Whoever is the seller, he will receive the premium. I just want to understand, you guys are able to understand? Is this clear? Just put yes in the chat box. Okay, so options are basically clear, a contract in future for an underlying. Options, what are the usage of the options? Two things. I will hedge my position or speculation. Hedge my position, let me give one simple example. For example, take example of say Haldiram, right? Haldiram has to manufacture a lot of snacks. For that snacks, he consumes 100 tons of the pulses. He need to pick up the pulses from the market. So what is going to happen? He needs 100 ton of pulses every month, but he knows that the price will fluctuate. So what he wants to do, he don't want to spend a lot of money on the pulse. So he will buy the future contract every month from now onward till the year end. So what he has done, he has essentially secured the supply of pulses at a fixed price. If the price escalates, nothing is going to happen to Haldiram, because he is going to get that 100 tons of the pulse at a specified price. Take the same example for the airline industry. Airline industry, the biggest input cost is aircraft oils. Now the oil price will fluctuate. It can go up, it can go down. But as an airline, doesn't matter to me. I'm going to consume the oil. So if I'm going to consume the oil and there is a certain amount of the oil which is required, so I can enter into a future, I can enter into an option contract for futures in the future time frame for whatever amount I'm going to consume, and I have locked in the price. That's nothing but called as hedging the position. Same thing, if I'm not an oil consumer, I'm an oil producer, I'm Saudi, and I know that price is going to go up and down. But if the price goes too down, I don't want that position to happen, because I keep producing the oil. So I want to secure the right amount for my oil in the future, in the foreseeable future. So what I will do, I will sell my oil. I'll sell the options. So what I have done, I have secured the pricing for my oil which I am going to produce. So that's called as basically hedging. You have certain instrument and you want to hedge. That's called hedging. That's the primary purpose of the options. Okay? You have some position and you don't want fluctuation in price to adversely impact your position. So you want to secure, hedge. मेरा लाइफ है, मेरे लाइफ को मेरे को प्रोटेक्ट करना है, तो व्हाट आई एम गोइंग टू डू, आई एम गोइंग टू टेक द इंश्योरेंस पॉलिसी. सो आई हैव hedged my life. Okay, but in order to insure my asset, what I need to do, I need to pay the premium. Basically buying the option and I'm paying the premium. Clear है? दूसरा है, people are doing speculation. So they don't have any instrument, they don't have any underlying, they are guessing what would be the direction of the asset in future. If we all know gold is going to 70,000 rupees, so I want to speculate. Right now gold is say 55,000, 60,000, jo bhi hai. If it is going to go 70,000 in 2 months time, because Diwali is going to come, people are going to buy and all that thing, I will go and speculate in the market. So if I don't have, so speculation mein teen tarike se kar sakta. I can buy on the spot market, meaning I go down and buy the gold, physical gold, put in the, or go onto the exchange and buy. So that can be spot, or I can do a futures, meaning a future contract in a month time, 2 months time, but I need to put money in terms of 10%, 5%, whatever is the risk margin. The third option which is available is option itself. Basically, I buy, meaning right to buy the stock or the gold at a specific price by a certain time, a month's time, 2 months time, 3 months time. So that's a standard contract. Clear hai options? Can you guys put? Okay, Himanshu, you have case. If I have oil producer, okay, so whether I will do buy put or I will do. Generally, what I will do is I will sell call because I intend to sell the oil, or I can buy puts also if I want to hedge that. So generally, I will sell call. Or I will buy put also. That is also okay. Okay, I think options is clear. Okay. Two things: call option and put options. Call option simple hai. Call option is right to buy a stock at a specific price in future by certain amount of time. Okay, so is a right to buy. Whenever you are bullish on any commodity, you are basically buying the call option, because at future date you want to acquire that asset whenever you are bullish. So you call option is right to buy. Put option is basically right to sell. I will not run. I will not take the option exercise and all that thing in this moment. But let me just take the basic thing. So we have to understand the basic. Then we go down into the details. Call option, put options, good. Call, whether when you are saying the price will increase, you are going to buy. Put, when you say price is going to go down, you want to. So you will buy the put. You will buy the put when you are bearish. Clear hai? Okay. Now that contract specification has some kind of size that is decided by the exchange. 175 Nifty index hai, so 75 ka lot size hai. So don't go down into that details when at this moment. Just understand you are doing some 75 shares or 100 shares of Nifty. When you are um, saying options, right? Options के अंदर में आपके तीन चार चीजें you are comes into the play. One is the direction of the price. When you are saying the price should increase, you are betting on the direction. You are buying a call. When you are saying the price should go down, you are betting on the bearish nature of the price. So you are basically looking at the price. जब आप stock खरीदते हैं, you are also betting on the direction of the price. The second thing you are betting is on the volatility. What is volatility? Very layman term, I'll explain volatility. Fluctuation in the price. When you see some stock which moves lot of up and down, up and down, up and down, right? That stock will have more volatility. Volatility is nothing but standard deviation. Simple hai. Meaning, if the stock is moving up and down like sinusoidal manner, lot of up, lots of down is volatility. High volatility. And when the stock is going very smooth, right? Very smooth, very calm and quiet, it goes 10 cent, 1 to 2 rupees going up and 1 or 2 rupees going down, volatility less. So that's there. The third one is time decay, because you are entering into a contract. That contract will expire by certain time. So wo certain time mein you are betting that price should come in your favor. Okay, if I have bought the call option, right? I'm a buyer. So what I'm betting the price should increase. Okay. So now, if 10 days has passed and price has not increased, what will happen? My option ka premium will melt down. I'll start making losses on the premium of which I have paid. So time decay will hurt if you are a long call. And leverage. Leverage, why it is leverage? Because you are able to you don't have the money, enough money, right? 100 shares multiplied by $100, $10,000 nahi hai. You have put only $200, $300. If suppose the premium is $3 per share, $300 you have put. In that $300, you are managing a $10,000 position. You don't have money, so that's a leverage. Second thing is probability, because you know the past performance of the security, how the historically the security has performed. So you will have some kind of statistic. Now history doesn't repeat, right? History gives you only a kind of indication. No one has thought that corona will come, and lot of time your 3 sigma event will keep happening in the life. But 68%, 70% time, 80% of the time, you will have little bit of understanding of how things will work out. So that's where the probability will come to know whether you are buyer or you sell. It is not necessary that it will uphold. Stock market doesn't know that you have learned the probability, and stock market will not oblige to your probability calculation. But you can keep your little bit of calculations that if worst case happens, what will happen. So you have all that 4 5 options, parameters which you need to take care of. This slide takes time. Any questions at this point in time? I'll take. Is very basic. Okay, very basic options. Basically, a contract in future for an underlying at a specific price, whether I'm going to buy or I'm going to sell. Options will have two party, buyer and seller. Okay. Here, what happens if the contract time is over? If the contract time is over, there are couple of scenarios which will happen. Okay. So suppose I have taken a call of $100, meaning I have a right to buy the stock at $100 by next month, say 14th March. Now come 14th March, if that stock is settled at 120, so I have a right to buy at $100. Stock is settled at 120, so $20 profit I will get it. So that option is in the money. Hold on to this particular question. I will have to show the diagram so that people can understand. So there can be multiple options. Either the option is settled in the money, either the option is expiring worthless. So this can be the couple of scenarios which will happen. The conflict. Basic clear hai? Okay, I'm going to the next slide. Next slide is a profit expectancy diagram. Take a profit expectancy diagram. Let me read it this way. On the y-axis, we have profit or loss, whatever. And on the x-axis, we have the stock price at expiration. Okay. I entered into a contract for a stock price. On 14th March, what is the stock price at expiration? That expiration day, that's a reference price. And on the basis of that price, I'll determine whether my option is in profit or is in loss. And it is a zero-sum game. If the buyer is in profit, seller will have to pay the money. If the seller is in profit, buyer will have to pay the money. So it is zero-sum game. Okay. Now this diagram is essentially what it is showing. At a varying stock price, expiry may, the price can be anywhere, right? From zero, it can go up to infinity, right? Anything can be the stock price. Now, at a particular price point, what is the profit or loss for that position? So at this A, the profit is, or this is the loss, this is this much loss. And if price keeps going down, there is the constant loss. This is what this diagram says. And if the price keeps increasing, this profit keeps increasing. So it is unlimited profit. If the price keeps going on increasing, the profit is unlimited, theoretically. This is a profit expectancy diagram. Clear enough? Stock price at the expiry. On that day, we will calculate the profit or loss of a contract, which is essentially option. It depends on what type of contract we have. Yes, this is a call option. This is a call option. But just understand, it is basically a diagram showing the profit expectancy. Now, options are very good. You know, you can make smart, high probability trades because there are inconsistency in the market. Provided you have understanding of ability to read the price, time, volatility, lot of things are there. What I would say is, stock price में अगर आप समझ में आता है, futures में समझ में आता है, and if you are making little bit of money, then you can graduate towards the option. Options, you can place small bets here and there, but if you are not able to make the money in stock trading, if you are not able to make the money in futures trading, how will you think that you will be able to make money in options trading? तो थोड़ा बहुत समझ में आना चाहिए. You should have a right direction with the limited period of time in the right time frame, also the volatility. तो तीन चार पैरामीटर बढ़ जाते हैं, but the profitability is also very high. Very quickly you can make money. At the same time, very quickly you can lose money, and a lot of it. And generally, the novice traders, they lose a lot of money. 80% of the people who are buying the call or buying the put, they lose the money. The writers make the money. But I'll refrain from any of that complexity at the moment. Let me just explain a little bit of terminology of the options. Okay, call option basically is right to buy the stock at the future date. Call option meaning long call is right to buy the call. ठीक है. Put option is right to sell the stock. ठीक है. एक चीज है, point is always the call will have a strike price. What is strike price? Basically a specified price in the contract. So my strike price can be anything. My current market price can be say 100. I can make a contract for 110, 120, 130, or I can make a contract for 90, 80 and all that thing. It's basically a contract between buyer and seller. So they can decide anything. Generally, it is decided by your board, your OCC or your predefined contracts will be there. It is standardized. But if it is non-standardized, you can decide any price. Buyer or seller के बीच का agreement है. So suppose current market price is 100 and you decide to enter into the contract with a strike price of 100. So current market price is 100, strike price for the contract is 100. It is called at the money. ATM बोलते हैं उसको, at the money. At the money can be call, at the money can be put. Whatever contract is there, if it is nearing to the current market price, it is called ATM. Okay. And when the price increases more than 100, it becomes 120 and all that thing. It is in the terms of call option, it is called out of money, OTM. And if the price is less than 100, it is called as in the money call. Okay. Basically, what is it? Why it is called out of money call? Because right now you can buy at 100, but you are entering into a contract. If it is a long call, right? You are entering into the contract saying that I want to buy the stock of A at 120 rupees on 14th March. Fair enough. So 14th March को मैं 120 में buy करूँगा. Today's price is 100. So essentially, what is it? I'm saying that call is out of money. Because if I exercise at any point in time in near future, and if the price is still at 100, I won't be able to exercise because there is no profit, right? There is no value in that call. अगर market में 100 में मिल रहा है, तो why will I go and buy for 120, right? It is expired worthless. So it's basically out of money call at this moment also with reference to current market price. But for example, if I enter into a contract and I say on 14th March, I'll buy the call at 80 rupees price. Correct? So when I say I will buy at 80 rupees price and seller agrees that, okay, I'll give it to you at 80 rupees, but the current market price is 100. So essentially that is in the money call, because the intrinsic value of that call is 20 rupees by default. क्योंकि आज मैं उसको exercise करूँ, if I exercise this call right away, and if I say, give me the call for, give me the stock price for 80 rupees, right? I'm in the profit because I can go into the market and I can sell it for 100. So I'm in the profit of 20 rupees basically. So that is called in the money call. So clear hai ye? In the money, at the money, out of money. Current market price is 100 and this is that. This is clear in the money, at the money, out of money wala concept. Okay. Okay, fine, good. Now let me speak about the put option. Call option kya tha? Call was right to buy the stock. Okay. Put option is right to sell the stock. If I'm long put, I'm saying right to sell the stock. So I'm saying current market price of the stock is 100. Okay. And I bought a put. So I'm entering, bought a put meaning I'm entering into a contract. And buy a put meaning right to sell. So I'm saying I have a right to sell this stock at 100 rupees. Okay. अब वो 100 rupees का है. And say suppose in a month's time that stock has become 80 rupees. Okay. But I have a right to sell it at 100 rupees. Good. Fine. हमारा ऑयल प्रोड्यूसर का एग्जांपल मैं if I buy a put, meaning I am saying I have a right to sell the oil at $100. Now the oil has gone to $80, doesn't matter because I have a right to sell at $100. When I exercise, I will be able to sell at $100. Finish. अगर मैं पूरा speculator हूं तो I'll sell it at 100 and I'll buy the oil at 80. I'll make good of this. So $20 का profit है. Sorry. So point is current market price के ऊपर का अगर put है 120 put or so, it is called as in the money put. Right now is at 100 and I have a right to sell at 120. If I have a right to sell at 120, intrinsic value in the call is $20 already, 20 rupees already. That's the intrinsic value. Plus I'll have to put some kind of premium because I still have 1 month to go. When I have 1 month to go, the stock can go down to 80 or 50 level पे भी जा सकता है if it is a bearish market. So that's the risk. So for that risk, the put writer will ask for more money. So 120 में 20 is the intrinsic plus there is a time value, extrinsic value. Extrinsic value will have two things: time value and implied volatility. We will cover whatever is that. But you understand, in the money put, if the strike price is high, here I am saying right to sell at 120, right to sell at 100, right to sell at 180. Why will somebody will say, abhi to market price is 100, why I want to right to sell at 80? Because people are thinking it will go down, it will crash, something will happen. So they are okay to go at 80. Okay. In terms of the premium, just understand. In the money call hai, the premium will be high. At the money, premium will be reasonable. And out of money hai, the premium will be less because risk is less, because the intrinsic value is less. So the price of in the money call is highest, reasonable, and lowest. But high low doesn't have anything. It has a value is what you are going to get it. तो वो देखना है. You don't have to see के price क्या है. You have to see the value which you are getting. Same thing. अगर in the money put है, if it is in the money put, the price of that put or the premium will be high, reasonable, less. It will keep on reducing. Yeah, extrinsic value is always greater than 0. Extrinsic value is always greater than 0 because that is the time value there. It becomes 0 on the day of expiry. जिस दिन expire हो गया contract, there is no time left, there is no volatility left. उस दिन जो value है reference point के हिसाब से, उस दिन ये वाला chart काम है. On the day it becomes expiry, they will check what is the specified price, what is the current market price or the closing price, and with that reference it will calculate whether the option is in the money, out of money, or at the money. At the money and out of money agar hai, so that will expire worthless. If it is in the money, the option buyer will receive the money. Sorry, the question I'll tell. What was the question? For the participants, let me tell you what was the question. The question from Himanshu was, is extrinsic value always greater than 0? Answer is yes. And extrinsic value same across in the money, at the money, OTM? No, extrinsic value will vary. Okay. OTM extrinsic value is very less. In the money, extrinsic value is less. At the money has the highest extrinsic value. अब वो जब अंदर जाएंगे तब समझेंगे. Extrinsic value calculated out of scope. I can't explain, meaning it will take a lot of time. I can't explain it. This is Black and Scholes formula is there, and then based on this is there. My screen sharing is paused. I don't know. 1 minute. You people are able to see my screen?
Yes, Piyush, we can see your screen.
Okay. Okay. And how much time we are? How much time we are left?
Piyush, we have to take some cues also. So,
Yeah. Okay. Okay. Fine. Guys, I will skip this little bit basic. Basically, contract hai, तो contract will have some expiry date, days to expire, and a contract multiplier. ये जाएंगे. अभी मुझे लगता है कि with the current pace and understanding, let's tackle 4 strategy. ठीक है? Long call option, short call option, then long put and short put. Okay, let's try to understand this basic first. What is long call option? Basically, let me hide myself. Okay, basically it is right to buy. Simple hai. It is right to buy. Okay, now for example, I bought a call at A. The current market price is say A, and I bought the call at A. What I'm essentially doing, I am a long call, meaning मैंने buy किया, and I bought the right to buy the stock in future, a month from now or 2 months from now, whatever is the expiration date, at a strike price of A. Agar price of the stock has increased in next 1 month, which is my view because I'm bullish, I will have a profit. Theoretically, a stock can double within a month, 2 month time. हो सकता है कभी तो भी. Okay, so I will have theoretically unlimited profit potential. Okay, in order to have that right, I have given some kind of premium because the seller, whoever is the other counterparty, he is giving us that privilege. So he is taking the risk. He is taking because he will make good of. If you are in so much profit, he will be in so much loss. So he will make good of your profit. So for that purpose, he is obliged to receive some kind of premium. So who'll pay the premium? Whoever is buying or whoever is long will pay the premium because you get the right to buy. The counterparty will receive the premium because he has obligation to sell. So there is a right to buy. The counterparty will have obligation to sell. Simple. Long call option. I am very bullish in the future. Your stock price increase होते जाएगा. That's why I am trying to buy the right to buy the call, buy the stock at price A. A can be a current market price. Doesn't
yeah,
matter. You
Piyush,
can.
Piyush, your screen is frozen on option quote.
Oh, sorry. Sorry. Let me reshare the screen. Is it visible now?
Uh, no, the same slide is being shown.
Yeah.
Yeah. Now we can see the long call option slide.
Long call options like perfect. Thanks. So long call option basically it is right to buy. Sorry, right to buy. You want to buy at strike price A, and that is the setup. And basically you are bullish, very bullish in this case. Break even क्या होगा? If suppose strike price A and you have paid a premium of 2 rupees or 3 rupees, your break even is स्ट्राइक प्राइस प्लस 3 रुपीज. तो ये इतना आपका ब्रेक इवन है. उसके बाद में अगर प्राइस यानी 103 एग्जांपल 100 इज द स्ट्राइक प्राइस एंड 3 रुपीज और $3 इज द प्रीमियम. 103 के बाद में यू विल स्टार्ट मेकिंग मनी. If it becomes 110, you will make $7. But your loss is limited to $3. If the price goes down from hundreds and 90, 99, whatever happens, your risk is limited because you have right to buy. What you will do, you will forego that right. You will not buy the stock. तो आपका क्या price गया? The whatever premium you have paid, that is the maximum loss. Maximum loss is the premium. And profit unlimited है. बहुत अच्छा strategy दिखता है. Okay. In terms of the Greeks, इतना समझ लीजिए, you are long. You are long. Whenever you are long, you have a right to buy up to a certain time frame. एक महीने का time frame है. तो basically, time is your enemy because every day, if the time goes and the price is not increasing, you are losing the value in your premium. So basically, it is called as time decay. Time decay is the enemy. Whenever you are long or whenever you have a right, you will have theta which is negative. time will hurt. It is like a melting ice. Ice में से पानी जैसे निकलते जाता धीरे धीरे धीरे, and it will escalate as you go towards the expiry. It will drop down. The premium will drop down. So you want your direction, but you want your direction to be accomplished within the fastest possible time. ठीक है? Implied volatility जो मैं बोला था, implied volatility was price goes up and down. अब इतना समझ लीजिए, there are certain time frames in which the price of the stock goes up and down very high. In certain time frame, it is lull. So what will happen? Volatility is very high during certain period of time. Volatility is very low during certain period of time. Once you establish this strategy, because you are long, whenever you are long in options, you want, after you entered into the position, you want volatility to increase. क्योंकि volatility अगर increase होएगा तो the probability of that option expiring into profit will be high. Okay, so once you enter into the position, you want implied volatility to increase. Generally, you just see before there is any kind of event going to happen, yeah, political uncertainty or war and all that, what will happen? Volatility will increase. एक दिन स्टॉक मार्केट ऊपर जाएगा, दूसरे दिन नीचे आएगा, फिर ऊपर जाएगा, नीचे आएगा. There is uncertainty, and when there is uncertainty and implied volatility increase, your premium also shoots up because underlying risk is very high. When the risk is high, the option writer will say, give me more money to cover my risk, and option seller, option buyer will have to pay more money. अगर आप पहले से buy करके रखे और volatility has increased, it will benefit and it will jack up your premium price. अंदर जाएंगे तो समझेगा. Basically ये strategy उस time में अपनाना, you have to go when you think there is a bullish, when you are bullish in the stock in the near future. ठीक है? Most of the time अगर ये expire भी हो जाएगा if the price is not there. At the time of expiry, there are three scenarios. It is at the money. The stock price at the expiry stays at 100. So what is going to happen? Nothing. Your option will expire worthless. ₹0. Your premium goes away. $3 has gone. The stock price has gone down from 100 to say 80. That can be the second scenario. Your option is out of money. Call option is out of money. You lost your premium. Your premium was $3. The third scenario, which is favorable, which is we are looking for, is stock price settles above 100. 102, 103, 105 पे है. You will make money. Clear है? अभी लॉन्ग कॉल का दूसरा भाई है शॉर्ट कॉल. सो लॉन्ग कॉल में जहां पे था राइट टू बाय, देयर इज अनदर पार्टी हु इज शॉर्टिंग, व्हिच इज योर काउंटर पार्टी, एंड ही हैज ऑब्लिगेशन टू सेल. सिंपल है. उसका डायग्राम कैसा है? एज अ मिरर इमेज है ऑन द एक्स एक्सिस. यहाँ पे अनलिमिटेड प्रॉफिट है तो इधर अनलिमिटेड लॉस होगा. यहाँ पे लिमिटेड लॉस है तो यहाँ पे लिमिटेड प्रॉफिट है. मिरर डायग्राम है. ऑब्लिगेशन टू सेल. So option writer or short is obligation to sell. Why he is going into this kind of contract? Because he thinks that stock price will not increase. He is little bit bearish or he is neutral. So he is betting that stock price will not increase. And you are betting, if you are a long call, you are betting the stock price will increase. So दोनों भी opposite view ले रहे हैं. One guy is saying price will increase, other guy is saying price will not increase. Okay, if price is not favorable, price increases, he makes the loss. If price is favorable, either expires at A or less than A, it will be neutral. He will keep the premium whatever he received. So his profit is very limited, $3 ही है, but his loss can be unlimited. Theoretically unlimited है basically loss. But people go into this kind of strategy, and nothing wrong with that. But this is also called as naked ऑप्शन. नेकेड यानी शॉर्ट है, तुमको मालूम ही नहीं कितना लॉस है, अनलिमिटेड लॉस होते जाएगा. ओके, अगेन योर थीटा एंड वेगा विल बी अपोजिट. अभी टाइम डिके, बिकॉज यू आर अ शॉर्ट, फॉर ऑलवेज शॉर्ट पोजीशन टाइम डिके इज अ फ्रेंड, बिकॉज एवरी पासिंग टाइम यू विल कीप गेटिंग, यू कैन कीप द प्रीमियम. आपका प्रीमियम इरोड नहीं होएगा. और volatility जो है, you want volatility to go down. After you have entered into the trade, you want the volatility to एकदम शांत हो जाना चाहिए stock. If it goes down, there is less chance of increasing. वो थोड़ा सा probability उसके favor में आ जाएगा. So you need volatility to go down, implied volatility. ठीक है, दिस इज ऑल्सो वेरी गुड ऑप्शन. व्हाट हैपेंस इज, एग्जांपल मैं बताता हूँ. फॉर एग्जांपल एप्पल का स्टॉक ले लो, इफ इट इज ट्रेडिंग एट $100, राइट, मैं एकदम ओटीएम में जाऊंगा $150 फॉर नेक्स्ट 1 month or 1 week. नाउ डू यू थिंक in 1 week it will become $150? Very very less probability, although there is a chance, 2-3% chance, but $150 it will not come. Now if I sell at $150 and even if I get a 10 cent 20 cent, what is going to happen? For that 1 week I'm taking a unlimited risk, but I can keep that premium. Now guys, you're clear on long call and short call? Clear hai? You can put in your comment box or you can speak also. ठीक है, बहुत टाइम लगता है इसको स्टार्टिंग में समझने को, पर दे आर वेरी बेसिक. हाँ, लॉन्ग कॉल, शॉर्ट कॉल. लॉन्ग कॉल राइट टू बाय, उसका काउंटर पार्टी ऑब्लिगेशन टू सेल. ठीक है, अभी what is long put? Basically you are nothing but a bearish. You feel your outlook is bearish, you feel price will go down and you want to profit from that bearishness of the stock. तो हम लोग क्या करते हैं, what we can do, we can short the stock, right, we can sell the stock, we can short the stock. तो short stock नहीं करना है तो we can do a long put, we can buy the put option. You are long put. Basically long put is nothing but a right to sell at a predetermined price. So समझो your current market price is A and your strike price is also A. You are saying I have a right to sell at $100. Finish. So I want a right to sell at $100. And tomorrow if the price goes to $60, what is going to happen? You have earned $40 profit. अगर प्राइस टूट गया $100 से $60 हो गया तो $40 प्रॉफिट, बिकॉज यू हैव अ राइट टू सेल एट $100 फॉर नेक्स्ट 1 month तक आप $100 में उसको बेच सकते हैं, तो इट विल गो डाउन. तो थ्योरेटिकली कितना प्रॉफिट है? अनलिमिटेड हो सकता है, पर अनलिमिटेड इज अ स्टॉक प्राइस कैन गो टू जीरो ओनली. तो $100 है तो 100 से जीरो तक जाएगा, तो माई प्रॉफिट पोटेंशियल इज $100. मैं आज लिया एनरॉन का स्टॉक लिया $100 में और $0 हो गया नेक्स्ट 20 days, तो माय प्रॉफिट इज $100. दैट्स द मैक्सिमम प्रॉफिट आई विल गेट. इट इज अनलिमिटेड इफ द स्टॉक गोज डाउन टिल जीरो. और जो लॉस है, लॉस इज माय प्रीमियम. इफ आई एम टेकिंग अ बेट कि प्राइस विल गो डाउन, but if the price increases, I am not going to lose anything. I'm going to lose only the premium which I have paid, not more than that. My maximum loss is limited to the premium. Clear है? Reliance का स्टॉक 2000 में लेके बैठे हुए हो, you want to do a put option, so you can say right to sell at 2000, and if it goes to 1800, 200 rupees का benefit रहेगा. If the stock goes above 2000 to 2100, 2200, your loss is limited to the premium whatever you paid, 100, 125 rupees जो भी किया है, that would be your limited loss. Clear? Long put option is basically right to sell. You will only benefit if the price goes down. If price goes up, your loss is limited to the premium you paid. Greek simple है because you are long. अगर long है तो क्या है? Your time is enemy. Every passing day you are holding a ice which is melting. So every passing day तुम्हारा value कम होते जाएगा. और implied volatility, because you are long, after you enter into the trade, you want implied volatility to explode. ऐसा कुछ हो जाए कि रिलायंस के अंदर का कुछ आ जाए इवेंट मार्केट में, फिनिश. तो तुम्हारा वोलेटिलिटी ऊपर नीचे कुछ भी हो, इट विल बेनिफिट योर long options. Whether it is long put or long call, both options will get benefit. So whenever you are long, you want volatility to increase. जैसे long है उसका भाई है short put और naked put. तो short put जो है उसमें देखिए यहाँ पे short put, you are bullish on the stock, and if the stock melts down, you will have unlimited loss. Unlimited loss until the strike price goes to zero. तो इतना लॉस आपका हो सकता है, बट your profit is limited to the premium you have received. तो counterparty for long put is short put guy. So both are counterparty to each other. ठीक है? In the short put or your writer, basically your profit is limited to the premium what you have received, your loss is unlimited. Or Greeks may again the same thing hai, your time decay hai, is your friend, because you have written a contract, and every passing day if the stock is not moving, it is helpful to you. And implied volatility, you want volatility to go down because you are having the short position, is opposite to the long. Clear hai ye? Yeah, Devesh, you're right. Profit potential is not unlimited, it is limited to the value of the stock in terms of this. Yeah, you're right. The price can go only till zero. So your profit can happen only till zero. So you're right, Devesh. You guys are clear on this slide? Long call, short call, long put, short put. Guys, you need to say yes in the chat box. Rohan, should we take questions at this point in time?
Yeah, we because we are already running short of time, we can take the questions now.
Okay.
So I'll request the audience to put in their cues in the chat box. We'll pick it up from there.
Guys, what I can say is this is the basic building block of option strategies. There are close to 30 to 33 strategies. It would be combination of all such strategies, and you can decide your time, duration, volatility, strike price, and you can accomplish whatever objective you want to accomplish. So there can be a lot of things. I will take the, so this was only a basic, with the time available, I could cover only the basic piece of it, but there is a lot to it. I will take the questions now.
Yeah, so the first question from Paresh Rajput is, how does high volatility help in put options? Could you explain with example?
Okay. Let me give example of what is volatility. Volatility.
Piyush, if you can shut your screen sharing.
Okay, yeah, yeah, yeah. Okay, so Paresh, high volatility, I'll just give the explanation. What is volatility? Volatility is nothing but the standard deviation. Standard deviation, basically, the price is going up and down. Next, we don't know the direction of the price. Price can be going up one day, second day down, and down further. For 2 days, it can go up, and whatever it is. The volatility is just the representation of standard deviation. How far the stocks is moving from your average. Okay. Now, when we say high volatility helps the position, meaning only when you are long, the volatility will help. If you are short option, volatility will play opposite role. So let's take example of high volatility in the long put option. Long put option meaning you have right to sell. Now the price is going up and down, up and down. So जब down आएगा, so there is a chance that price will go down and go below the strike price. So chances of your option going into moneyness is higher. Hence, high volatility will increase the value of long put options. Same is true for long options. Okay.
Good morning, sir. Just one thing, as you said that long put option with the volatility, the price keeps going down, we will be beneficial. But my question was that in volatility means the price can also go up as well. So in that situation, what would be the scenario? Like we'll be at an disadvantage, right?
Okay, I got your point. So when I say, because there are multiple parameters which are operating at the same time, if everything else is same and I take volatility into account, higher volatility means higher premium.
Yeah, sure, sir. Thank you.
Yeah, so the next question is from Devesh. He's asking, what is your favorite options trading strategy?
Okay, So the historically the edge is for the option writers. Okay, so and the situation or the context changes so much in the stock market. So I may be bullish on one stock, I may be bearish on other stock. I don't generally do trade on the stocks, I trade on the indexes. So that will keep changing. If it is high volatility, then I am the short or seller of the options. If it is low volatility environment, I am buyer of the option. But I like limited profit, limited loss kind of. So verticals and all that is good. But then depending on different situation, I go into different types of strategies.
Himanshu is asking, can you recommend a book on options for beginners?
Okay, this is a good question. You know, in 2007, I wanted to go through a book which can explain me a lot of things. Frankly speaking, there is a lot of material available. It took me a lot of time. I read maybe 50 plus books on the options. Okay, what I can recommend, very basic. Giroda has one option book of 200 page, 225 pages. Very good for beginners. Close your eyes and just read that. That is one. Second है there is option playbook on internet. That is also good in terms of the diagrams and understanding that you can do that. The third thing is, which I got late into my life, is on YouTube there are videos which is called Options Alpha. So 3 resources I'm sharing. If you're a kind of guy who wants to read the book, Giroda, there is some called options book is there. Then your options playbook on the internet, it is also good. And the third thing I'm saying is Options Alpha, YouTube channel. What I would say is there are a lot of mathematical books. John C. Hull, ये वो, भैया उसमें नहीं जाना. Don't go into that. You are not at that level. Don't try to understand the basic terminology, this, that. Then if you are literally interested in kind of scholastic, go down into that. I went there, it is a waste of time. उससे सिर्फ mathematics intellectual power बढ़ेगा. It won't help or too much into the trading. You can keep reading, but there is a one book only on volatility. Amazing book. But Yuan Sinclair, I'm in touch with that author. But in order to understand that book, you need to have 2-3 years of solid understanding in options. So day one, if you pick up that book, nothing is going to happen because you are not going to understand anything. But chances is you will stop liking options. I'm saying go to the small books. And these are like basic alphabet सीखेंगे, ABCD सीखेंगे, बाद में आगे जाएंगे.
Next question is from Kostub. It's slightly out of context. How to interpret the open interest and put call ratio to determine the direction of the market?
Kostub, I will say stop doing all that kind of thinking, right? Don't go get the edge out of that. What I'm saying is mota pakro. How is the price going up, price going down? You just read bigger. You will get a sense in the market. Okay, like Biaz was mentioning the other day, right? Understand how the charts are working out, how the context and all that thing is working out. I tried doing this a lot of time. I understand the logic behind put call ratio and open interest and all that thing. It also gives you an indication that this is wall of worry. अगर बहुत ज़्यादा open interest है, उससे ज़्यादा price will not go down, but that doesn't happen. When it breaks, the market breaks. When market goes up, market goes up. तो वो लॉजिक होल्ड नहीं करता है. So my suggestion is try to understand the bigger piece of it, and that will also give ample money. Don't try to improve your edge by 0.1%.
We have again a question from Himanshu. He has 2 questions to ask. First one is who wins when the options expire worthless? And second question is, how are ESOPs related to these options? Are those ITM or ATM?
Okay. Who wins when option expire worthless? Whoever has written the option, he wins because he keeps the premium. The other guy loses the premium. Okay. Both sorry 80, 60, 70%. I don't know the statistics, I won't quote, but a lot of people have edge over writing. Whenever they will write, they will out of money write karke rakh lo. What is going to happen? Because people are buying lottery. If they are buying out of money call option or out of money put option, they are buying lottery. So who gives the money in the lottery? Maximum time the person who has created the lottery. So that's there. Who wins? The option writer wins. पर जरूरी नहीं है जिस दिन उसका लॉस होगा बड़ा लॉस होगा. So it is contextual, but generally whoever has written the option wins it. Whoever has written the lottery. In terms of the ESOP, end of the day simple है. Whatever is your contract and what is going to happen in the expiry. So what is the strike price and what is the market price at that point in time? Some point in time it helps, some point in time ESOP doesn't help. Depends. Last month, if the company has grown much, it will be in the money, everything will be profitable. If the company prices has gone down a lot, you are not going to get any money. So they are nothing but as simple options your market may.
Piyush will take the last question because we are running short of time. So the last one is from Harsh. He's asking, what is the impact of option trading in stock market and vice versa?
There are a lot of studies around that, because whoever is market participants, they are everywhere, right? They are into the stock market, they are into futures, they are also into the options trading. So there is impact, there is a little bit of understanding which will come through. So this question is also related with this question, put call option ratio and option interest. My thought process is, yes, there is impact, but my suggestion would be don't go down into that details. It is not required. Go down into the big directions and you will make ample money if you go into the big direction. Keep it simple. क्योंकि अपने को जितना लगता है कि we are very sophisticated and we can make lot of money, sophistication brings only the confusion, doesn't bring money. If you want money, you just go and keep your trading simple. अब सबका analyze करके क्या करना है? And we are all engineers, right? We want to analyze to the details. That is the place where we are losing. नहीं analyze करना है, simple रख के take a call or put whatever it is.
So Piyush, before we conclude the session, just concluding remarks from your side, and then we'll conclude.
Yeah, I do have one. Yeah, there is a question on the line.
I'm sorry to interrupt. Yeah, I have a question for Rohan actually. Rohan, where can I get a PPT or the recording of the last sessions?
We have a YouTube channel, the Nagpur IIT BAA Nagpur chapter YouTube channel. I'll share the link on the chat group. From there, you can we upload all the videos over there of the wealth management series.
Okay. Thank you very much.
Okay, thanks. Concluding remark, what I would say is option is very exciting. One thing I will suggest is you go and read a lot, practice on the paper, play only with the amount which you can afford to lose. You will be making losses, but you will be learning as you go along. So don't go overboard. Risk management is the only lesson I want to give if I want to give in the options trading. So it's a good knowledge which I wanted to give. The second message I want to give is, we earn a lot of money, but not for oneself, but to give back. Okay, so there are a lot of people around us who are not intellectually advanced or who don't have the opportunity like us to earn the money, and they are really they don't have any future, and we can see a lot of the cases. So earn enough for you, spend on yourself, no problem. End of the day, give an intention to give back, and karma is there. We get lot of money back when we give back. So I would say that utilize your skill, knowledge. Don't hold yourself, earn a lot, but at the same time take care of society.
Thank you. I thank Dr. Piyush Mehta for taking out time from his busy schedule. I've been interacting with him for the past few weeks, and he's been keeping very busy. And we are very grateful कि आप समय निकाल सके. And we had a very wonderful and insightful session. Options are so complex. We need a experienced hand-holding at least to begin somewhere in options. So it was a very insightful session, and I'm hopeful that the interested people will start doing their own research based on the inputs we've received from you. And I thank again the Hyderabad chapter who've been mentoring us for the wealth management series, and Praveen who helps us in organizing these speakers. And like every month, we'll again meet next month on the second Sunday. And I thank all the audience who could take their time out on a Sunday morning, and hope to see you again in our next edition. Thank you all.
Thank you. Thanks.